Welcome to Retirement Planning for Individuals. In this unit standard, we are going to look at how do we plan for someone to be able to retire comfortably, either at the level that they are or at the level that they will be once they retire in terms of their standard of living, or maybe a little lower because most of the people would like to downgrade in order to make enough incomes, available for them to continuously live comfortably. For instance, they will downgrade a house, downgrade a car. So what is important is to look at the different factors, including their age, including how much income would they need, including at the time that they retire, if they are sickly people, or if they have got any chronic disease, would they still need to keep a medical aid that is costly? Those are some of the dynamics that we need to look at. But we also look at the structuring, of the pension fund, or the structuring of their pension. Should we be taking all of the money into a retirement annuity, for instance, or should we have a combination where we give them an exposure maybe to property, an exposure to direct equities, at a later stage? So these are some of the dynamics that we'll be dealing with. We'll be dealing with the issue of tax, once they start contributing to a pension fund or to a retirement annuity early. Obviously, they start saving on those pension contributions. At a later stage, when they withdraw, which bracket they might be in, and what are the possible tax effects at that particular stage for them when they withdraw the money at their retirement. And remembering that they are only allowed to withdraw a certain portion, only about 1/3, and the 2/3 goes into buying an annuity, which they should be able to live with, continuously throughout their lifetime. There's different types of products as well in terms of, retirement annuities, or annuities that actually get bought. They are guaranteed annuities, there's living annuities, and, all of them serve different kind of purposes. And if we go and make a mistake of giving people, advice that is not good enough, they might find themselves with, shortfalls, significant shortfalls that might lead to either, they have to sell huge assets at their retirement, or they won't enjoy what is possibly called the golden ages. So this is unit standard 242613. It's an NQLF level 5, and the credits, there's also 5 credits into it. So let's look at what the outcomes are looking like. It's applying your knowledge into the legislation. This is a highly regulated industry in terms of pension funds, assessing the objectives and provisions to a financial strategy. We construct a portfolio based on the and the risk profile of this particular person, and we then provide recommendation. And what would be the impact of that is that we're looking at the lifestyle or the cost of the retirement products, impact of lifestyle, the kind of lifestyle that we have, what would be the costs, because how much you acquire the retirement products, depends on the lifestyle that you have. The higher your living standards, the higher, the cost of acquiring that retirement product and making it, probably easy for you to retire later. The impact of age, the older you are, obviously, it means that the more it's going to cost you, for that lump sum that you need at retirement. And the assumptions that are going to be made, in terms of mortality and socioeconomic status that you will be in at retirement. For instance, you'll be someone who is maybe who has a chronic disease. If a client has, for instance, chronic disease, and they might require medical aid that is very expensive, in terms of, how long would they live, because the longer they live, the more money they are going to require for their retirement years. So those are some of the implications of the decisions that we are going to help, our clients make. So what are the features of this pension, planning is that there's retirement annuities, which obviously can be bought from a insurer, there's pension funds, either from a public sector or from the private sector. There's provident funds also from either a public sector or public sector. Provident fund obviously being different in a way because you can access all the money when you resign. With pension funds, you obviously have to wait for at least your early retirement, which is at 55. And then you've got your preservation funds. Your preservation funds is where money actually gets parked when you change employer from one employer to another. That money, especially when you don't want to take it, or you don't want to withdraw it from a provident fund if you're in a provident fund. If you're in a pension fund, it will sit in a pension preservation fund, and if you are in a provident fund, it will sit in a provident preservation fund to preserve the money. Obviously, then that also means if you're not taking it, if it's in a provident fund, it also means that it's not exposed to tax because you haven't withdrawn the money. But should you withdraw all of it, then the tax implications will definitely take place immediately. And then you've got your annuities, which is money that you buy, or a product that you buy to safeguard your income after retirement. So that money gets, for instance, when you retire, 1/3 of it you receive as cash, and then the remaining 2/3 then buys this annuity that will give you an income on a monthly basis. So you've got also group products that are linked with the retirement products. You've got your pension, group provident, group retirement annuity, which can be sold especially to small companies who don't want to, put together a pension fund of their own. Then they can join almost like a group retirement annuity that is being run by an insurer. And then you've got your group disability, which are some add-on products, mostly on these retirement products, your group dread disease and your group income protection. Let's look now at different characteristics of a retirement annuity. For instance, a retirement annuity is a private pension fund that is obviously managed by an insurer. The contributions to that, to that retirement annuity are tax deductible. And if you had gone through the unit standards on tax, you know what tax deduction means. It means it's almost like an expense directly from your salary, which reduces the amount, maybe your net, and then it means you are also taxed at a very low bracket than you would have. The good thing is that this is not just an expense that is just flowing out. It's money that goes into your future savings, but it's deductible, which means that it reduces your tax bracket or the amount of the tax that you are paying. The retirement annuity itself is an untaxed fund. It means whilst the money is inside the retirement annuity, it's not taxed. So it's allowed then to grow significantly without any expenses that are taking away from the capital, reducing the potential growth, over time. And then, like we mentioned at the beginning, that 1/3 of the lump sum becomes available at the early retirement at 55 or at 65. And then 2/3 then goes and buys an annuity that should protect your monthly income. Then the retirement annuity is also protected from creditors. And then there's no loans or collaterals on a retirement annuity. Then let's look at the difference with the pension fund. The pension fund, the contributions are also deductible to a maximum of 27.5% with either 350 as a ceiling as well, which means if you have reached 350,000 per annum, according to the current tax table, then you cannot have deductible deductions on your retirement or your pension fund. This is the same with the retirement annuity as well. It's also limited on that 27.5 tax deduction. It's also an untaxed fund, and it shares the similar characteristics. as a retirement annuity. The only little difference is that with your pension funds, then there's trustees, and the trustees make up the rules of the pension fund. For instance, there might be no loans or collateral apart from company-specific loans. So company-specific loans will be home loans, for instance, that are pension-backed. It means they are able to, hold on to some of your pension to be able to extend a loan, normally at a little cheaper than when you actually go directly to the bank, because this is backed, by your pension. And then there's educational loans, and then, and losses to company as well. So, that is some of the, extensions of loans that can be extended to a pension fund member. Let's go into how a tax table works from our previous unit, standard on tax. You'll remember that the table works in an incremental form. So the amount that is between 500,000 and 700,000 will be taxed at 18% of taxable income above 500,000, because remember, the 0 to 500,000 is tax-free. It means it's not taxed at all. And then any amount between 700,000 and $1,050,000 is taxed at the first 36,000. The first amount is 36,000 plus 27% of any amount that is above 700,000. And then the second one, or the last one, is a amount above $1,050,000. It's taxed at 130,500 plus 36% of taxable income above $1,050,000. So that's how it works, almost the same as the tax table that we looked at when we're doing pure income tax. So it should be easy for you to be able to follow this. You just need to remember the different brackets that we have on pension lump sums. On provident funds, the characteristic of a provident fund is that the contributions are also tax deductible. It also an untaxed fund. It means the money is also allowed to grow, but the difference is that the percentage, the 100% lump sum, is available upon resignation, upon leaving an employer, and can be used to purchase an annuity as well. Post-retirement. It's also protected from creditors, and there are no loans or collaterals. So let's look at the types of funds that are available. You've got your standalone funds, for instance, and your standalone funds would be a fund that is, specifically for a particular employer. So, for instance, Eskom Pension and Provident Fund, it's for this particular employer. It's a standalone fund. It's not grouped with others. And then you've got your umbrella fund. Your umbrella fund will then be a fund that is grouped with others. So there'll be a couple of employers. For instance, unions have these kind of umbrella funds which represent different kind of small employers. So they will then get an administrator who will administrate their pension fund that's linked to the small employers that they have and their members as well. So that's an umbrella fund. For instance, sometimes there'll be umbrella funds that are representing a particular sector. So there'll be an umbrella fund for a hospitality industry, for the steel industry, and such. So there you then have a combined, joint administration, who are looking at the running of the pension fund, and you've got managers, investment managers that are looking at the growth of the pension fund, and you've got trustees that are representing the different employers as well. So that's how umbrella funds will be put together, representing all the employers underneath. You then have a preservation funds that we spoke about earlier that provides a home for capital from a pension fund. And then it's also protected from creditors. So that's the nature of the preservation fund. And then let's look at your annuities. So there's different kinds of annuity. A voluntary annuity will be the one that you obviously take by your own, to secure your income when you retire. And then there's your compulsory annuity that comes from your pension fund, or your retirement annuity. Remember saying that you only get access to 1/3 of your money as cash, and the rest then, has to be split, over time, and buys an annuity depending on what kind of an annuity and for how long it will be. And then you've got these annuities that are invested. So whilst they sit in this annuity fund, they are also invested into mostly, instruments that give continuous income. So they won't be exposed to too much risk. So these would be government bonds, for instance, and guaranteed income instruments, for instance, your money market. And some, for instance, are exposed to real estate as well, which provides consistent income. And then annuity types, there's conventional annuities that, would be your traditional annuity. There's the nil guarantee that we spoke about, which provides you with high income, capital lost on death. And then there's guaranteed terms, which pays until period is reached. So you are given an annuity until a particular time. If that time, arrives, even if whether you've passed on or not, the annuity state stops paying. That's the only disadvantage. And you've got your joint and survivor. Your joint and survivor, it means that, there's a couple, for instance, that takes an annuity at their retirement. When one spouse passes on, it will continue paying until the last spouse, passes on. So it just makes sure that the surviving spouse doesn't become vulnerable just because the one spouse has passed on. And then you've got the difference between living an annuity, which is, a living annuity, which is more flexible in terms of you can, predetermine, how much you are going to take from your annuity, unlike a guaranteed term annuity, which, they tell you how much you are going to get on a monthly basis. The living annuity, you choose each and every anniversary, like each and every year that, for instance, on the following year, I see that my expenses are quite high, so I'm going to need a higher income. So it has not locked you in. So that's the difference with a living annuity, the difference between living annuity and guaranteed annuity. And let's look at this in a bit more details. So for instance, in terms of longevity, living annuity carries all the longevity risk. So the living annuity makes sure that at least you've got that consistency, in your living annuity, in your annuity that you're actually getting on a monthly basis. On a guaranteed annuity, the insurer carries all the longevity risk. Income and increases are guaranteed for life, so that's the difference. On this one, the annuitant, the annuitant or the person is the one that carries the risk. So you, as the one that is taking the annuity, you are carrying the risk. Should there be market fluctuations, it means the capital, might, end before you actually pass on. So that's the risk that you actually have there. And with profit annuity, the longevity risk is pooled. These are mostly the insured ones. Is pooled, that is partly carried by the annuitant in the pool and partly carried by the insurer. So this is sometimes also called an insured annuity, or with an insured, a partial insured annuity. A minimum income is guaranteed for life out of that annuity. So some of it is exposed to the market and some of it is insured, by the insurer. And then there's the investment risk. The investment risk is that the annuitant carries all the investment risk when it comes to living an annuity. It's exposed to all the market fluctuations, but it also means that you are taking all the profits and taking all the losses. So should the market perform very well, it means that you get to benefit. Should it perform poorly, then you get affected because you're carrying all the risk as an annuitant. And then when it comes to guaranteed annuity, investment risk, insurer carries all the risk. the investment risk because they are guaranteeing you of the income that you are getting on a monthly basis. When it comes to with-profit annuity, annuitant is exposed to investment risk as increases are linked to investment performance. So at least, that portion is exposed to the market, a certain portion, and then a part of the investment risk is taken by the insurer. So this is a hybrid type of an annuity, which is, almost like a partly living annuity and partly guaranteed annuity, because some of the money is actually guaranteed by the insurer here. And then in terms of the death benefit, in terms of a living annuity, the beneficiary receive any remaining market value should the annuitant pass on. And then on the guaranteed annuity, once the period reaches, there's no money, that is going to, pass on to, if it's a nil guarantee. If it's a guaranteed period or joint annuity, then, based on the, the advantages or the characteristics that we spoke about before, that if it's a nil benefit, it means the person passes on, all the capital is lost. If it's a guaranteed period, the beneficiaries will get money as far as the period remaining. Let's say, for instance, the person had an annuity, a guaranteed annuity for 20 years. In the 15th year, they pass on. Then it means it's remaining with 5 years. So the beneficiaries will continue getting the money for the remainder of the 5 years. And then on the with profit, it's no benefit unless a guaranteed period or a joint annuity is purchased. So there's no guarantee with this one as well. When the person passes on, then that's the end of things as well. The income flexibility, like we mentioned, with living annuity, annuitant can adjust income annually at anniversary between 2.5 and 17.5% of annuity market value. So whatever the market value of the annuity that is remaining, you can adjust, or the person can adjust their annuity based on 2.5% and 17.5%. When it comes to guaranteed, annuitant has no control over the income. So, it's predetermined and it will continue like that for the rest of the annuity. And here, annuitant has no control over increases, as these are linked to the investment performances as well. So there's no control as well. So as the market performs better, then the annuity increases or becomes better. If the market is not performing well, then they get affected negatively as well. And then let's look at the different legislations that are affecting people with on an annuity. We've got your Pension Fund Act, that looks at the regulations of all the pension funds, including retirement annuities. They all have to oblige with everything that has to do with the Pension Fund Act, and it regulates how much money can be exposed, for instance, to risky assets like equities. How much money should be put as a portion, into providing an income, whatever actuarial calculations that are being made for different kinds of pensions. All of that is governed by the Pension Fund Act. And then you've got your income tax, which obviously looks at the capital gains tax when you receive your lump sum, which looks at your annuity when you get your annuity on a monthly basis. It also governs the tax deduction that you get on a monthly basis as you contribute to a retirement annuity or a pension fund. And then you've got your labor relations, which is looking at the relationship that has to be there in a pension fund. There cannot be a pension fund when there is no relationship between an employer and an employee kind of a relationship. So the Labor Relations Act looks at that as well. And then there's the Long-Term Insurance Act, which looks at the retirement annuities, because they are managed by insurers. Insurers are governed by the Long-Term Insurance Act. So retirement annuity is linked to the Long-Term Insurance Act as well. And then there's the Divorce Act in terms of what happens to the proceeds of the pension when people get divorced. For instance, they will say that the other spouse is entitled to a portion of the of the money that is in the pension fund, whether the person has reached the retirement age or not. The divorcing spouse is entitled to that portion. And then there's the Maintenance of Spouses Act, when the other spouse, they divorce, for instance, and the other spouse doesn't have sufficient money. The Maintenance of Spouses Act takes place that you need to take care of the spouse and maintain them in the kind of lifestyle that was there before the spouse's divorce. So the Maintenance of Spouses Act is there to protect spouses that were more vulnerable during the term or after divorce, so it's there to provide those spouses. Excuse me. Then what is the objectives of retirement or the pension funds? Is to look at your bond repayments. Sometimes you still have kids that are still in education at your retirement age. Is to look at the contingency money that's available should other investment not do well. It should look at the emergency fund, provision of medical expenses, covering any debt if you are still paying, other debts that are available, and obviously provides income at retirement. And then these are some of the risk benefits that are linked to a retirement. That will be your funeral cover, your death benefits, so that, the money that is being received is not affected. Because you can imagine if one spouse passes on and probably there's no life cover, and, the other spouse gets to suffer, especially when there's no joint or survivor retirement annuity. So the funeral covers is there as a supporting or, as a complementary product. A spouse's cover, a dread disease cover, a disability income cover, a pure disability, accidental death and disability benefits, and trauma benefits. So those are some of the benefits that can be, linked with any retirement products, or even outside of retirement products that people can actually take. Then disability benefits, we looked at disability accident cover, trauma cover, disability income, and mostly, especially on the group benefits, most of these, group retirement products will come with some of these risk covers. Should the person, get into an accident, should a person get into a trauma, should they be in a position not to have an income, what would happen? So all these things will actually be able to assist the person, to at least continue living, the lifestyle that they had before they got into, an accident or whatever that has led them to be affected as far as their income is concerned. And then the termination options in terms of, when you terminate your pension fund, the money can either go into a preservation fund when you are in either provident or pension fund, or it can be then transferred to buying a retirement annuity. Obviously, that's when you get into, the retirement age. So those are the termination options. When you leave your employer at retirement, you obviously terminate your pension fund, and the money gets to, buy a retirement annuity that will take care, of your income post-retirement. They are determined by the fund rules. So the fund will determine what are the death benefits, what happens when a person who was a member passes on, for instance. Are there any additional things that need to happen, and so forth. And then retirement benefits as well, what are the actuarial calculations in terms of, how is your pension fund determined? Those rules are actually made by the fund itself. And the rules are made by the trustees of the fund, with the obviously consultation from other stakeholders, like investment managers, actuaries that might be external and not necessarily work for the actual fund. Sometimes the administration also gets outsourced. And then in terms of the taxation, the lump sum of which is a third is taxed based on the tax table. So we spoke about the tax table, the first 500,000 in terms of the 2020 tax table is tax-free. And then the following one after 500,000 is taxed at 18%. So make sure that you just remember that tax table. The Palang purchases an annuity, and that annuity is taxed at your marginal rate. So depending on what your income bracket is at that particular time. Remember that the fund was not taxed when it was still growing. So now that it's in your hands, it then gets taxed based on your marginal rate, based on your bracket. The benefit might be that when you retire, your income bracket is a little lower, so you get taxed at a lower bracket than you would have been if you were taxed, during the time that you're contributing to the retirement. Those are some of the benefits. And then the types, there's the defined benefit and defined contribution, smooth bonus, managed funds, market-related funds. So the defined benefit is, self-explanatory. The defined benefit, it has, your pension fund is predetermined that if you were to retire at age 55, at your early retirement, this is what your pension fund would look like. So they use a certain metric. Normally they would use, income of your last 2 years before you retire, so they will say income of your last 2 years before you retire is this much, and then they will multiply it from there. So that's your defined benefit. You'll still be affected, but not severely affected by market fluctuation. So your pension is almost guaranteed. That's why there's been a lot of phasing out of these defined benefits, especially after the market crashes of 2007, 2008. So those market crashes, took a lot of pension fund capital down, which means a lot of pension funds could not guarantee the retirement amount anymore. So most of them started gravitating towards a different kind of form of pension fund, which is a different defined contributions. So the defined contributions, the calculation is based on how much your contributions have been. Even the defined benefit also depends on how much your contribution, how long have you been in the pension fund. It looks at your period, your salary, and so forth. But the defined contribution looks at, how much have you contributed into the fund, how the market has, fluctuated since you've been in the pension fund. So that is almost like exposed or exposing the person to the market, and it's not guaranteeing anything. The good thing is that if the market performs exceptionally well, then you get to benefit. If it doesn't perform exceptionally well, especially at the time that the person decides to retire, then they get affected severely, And then you've got your smooth bonuses. Your smooth bonuses is almost like your insured type of a pension, where there's a certain portion. It's almost the same as when we're talking about the profit sharing, or the profit bonus, where there's this almost a smooth bonus that shields the person from not being exposed too much to the negatives of the market. So when they on the upside, it's that they will be exposed to good profits of the market, but to a certain level. So they won't get all the benefits of profit exposure into the market. That's why you are almost cushioned from losses, but also not too much exposed to market profits. They then get taken obviously by the pension fund, and then they get your managed funds, which then are managed by external providers, and then you've got your market related funds, which are mostly exposed to the market, purely exposed to the market. Most of these funds are funds that are related to insurers. They are not funds that are mostly with companies or like standalone funds. These are mostly really related to your retirement annuity funds, where you get exposed to smooth bonus, managed funds, and market-related funds. Then let's look at investment vehicles that get exposed, that these pension funds get exposed, or retirement annuity get exposed to. So we've got your market-related. Let's look at the investment vehicles that these vehicles get exposed to. Market-related, it it fluctuates with the market. Absolute return, you are guaranteed a return, although there's fewer of these products in the market. Structured products would be those that are linked, with a different kind of products, almost like your hybrid type of products. And then you've got your smooth bonus products, almost like the one that I spoke about in terms of, being cushioned from losses, and then being cushioned also from, excessive profits, or returns, if you might put it that way. Multi-manager products, those would be the products that are actually managed by different asset managers. So you might be investing, with Momentum, and Momentum is a multi-manager fund that is managed by Sanlam, Allen Gray, Old Mutual, and other funds. So the investment is investing in other funds, and then there's other variations depending on the needs or the customization of products. So those are some of the vehicles that that are available, investment vehicles that are available, especially with insurers, that can be alternatives, to a direct retirement annuity, in fact. When it comes to risk analysis, we look at the profile, we look at the tools, and we look at the portfolio risk. And that will give you a portfolio. You choose a portfolio that is aligned to the profile of the client. So when you are doing this, obviously, you will be able to expose the client to unit trust, structured products. You expose the client, to a retirement annuity. So it won't be a one-size-fits-all, depending on what the needs of the client actually are at retirement. So you might find that retirement might not give the kind of excessive growth that the client needs at retirement, and they are willing to risk, and they're willing to forfeit some of the tax benefits, and they will choose to invest in some of these other products than a retirement. So in following that sequence, you do a risk profiling. We did a needs analysis. If you would have looked at another unit standard about needs analysis of the client, you look at the risk profile of the client, you input all that data into the assessment tool, you come up with a portfolio risk and choose the right kind of a portfolio or a mix of portfolio that will be suited for that particular client. Then let's look at the different characteristics of different products. Let's look at unit trusts, for instance. The risk tolerance, for unit trust is medium to high. For living annuity is low. For endowment policies is medium to high. For retirement funds is low. So most of these, you should know that the living annuity are not exposed to any risk. They are invested in income generating instruments like your bonds, for instance, and bonds are not too risky, and they are guaranteeing almost a return or a interest at certain intervals. So they are invested there. Retirement annuities also are regulated, by the Pension Fund Act on how much can be exposed to risky instruments like your equities. So that becomes low as well for that particular reason. And then endowments are a different product altogether because they then get exposed to the market, and that market, when it fluctuates, then can affect, the performance of the endowment policy. In terms of a term, recommended unit trust is medium to long term to allow, obviously, for the exposure into the financial markets, which might be lower at some stage and more volatile. It means more risk in the short term or medium short term, but they are more beneficial in the medium to long term. And living annuity, obviously, living annuity for the time that you actually need an income when you retire. Also recommended for long term. Endowment policy for medium terms, normally endowments would go for about 5 years. And then the retirement funds, and don't worry about endowments, we'll get into if you haven't done the different kind of financial instruments or financial products that include endowment policies. We'll go into that as part of the rest of your qualification. And then the retirement funds, obviously for long term, that you are locked in. In terms of tax efficiency, unit trusts on interest end, there's tax, and depending on the exemptions on marginal tax rate. So also the dividends that come from unit trusts, you'll be taxed at about 20% if you've done your tax unit standard, you will know this. And any interest earned obviously is also exposed to income. So any income earned and any capital growth in the unit trust actually gets gets taxed accordingly. Living annuity income drawn is taxable on normal tax rates. On living annuity at your marginal tax rate at your retirement. Endowment policy taxed at the rate of 30% within the fund. So unlike the benefit of a retirement where the fund itself is not taxed, endowments are taxed at 30% within the fund. And when you receive then the lump sum, it's already taxed. It won't be taxed in your hand. That's the difference with the endowment policy. And retirement funds taxed effective, no tax on build-up of period. So within the fund, the retirement funds are not taxed. In terms of costs, unit trusts are low depending on the type, but for instance, actively managed unit trusts can be quite high. So it's very important to shop around as well. For the client, especially if you are an independent financial planner or consultant, you need to shop around and make sure that you are aware of all the, there's also platform fees. Make sure that you are aware and the client is aware of all those, fees that are related to the unit trust. And then in terms of living annuities, medium, depending on the factors, age, occupation, that might be the costs, because the older the person is, the costly it becomes for them to guarantee the certain income later. And here, increased premium up to 20% per annum. So obviously, though, that will be dependent on the contract of the endowment, but there's incremental increases of the premium up to 20% per annum. And then retirement funds, medium to high, depending on age as well. It's almost the same as your living annuity. And then life events that could impact the retirement of an individual's retrenchment, resignation or dismissal, divorce, disability, whether permanent or temporary, the person starts receiving that benefit immediately when some of these things actually happen immediately, And then the important thing is to make sure that we match the anticipated personal retirement needs to available products. And this is how we will then come up with the investment solution, revising an investment solution and adjust it to meet the current needs. So at that time, you would have determined what are the needs of the client and, be able to do them, to meet those needs of the client with their retirement, solution that we actually provide. Then this is the financial planning, for instance, model that we can look at. First, we look at the balance sheet of the individual. We look at, what do they have already? What do they have already? So, for instance, assets. They've got property. They've got cash. They've got shares. They've got business interest. They've got pension. They've got the retirement annuity. Already. And then, we look at the liabilities. What are the liabilities that are there? There's a bond that they're already paying. There's something that on hire purchase or credit cards, estate duty that needs to be paid, capital gains tax on lump sums. Those are all liabilities that will eat out of the assets that are already there. And then you don't say the balance multiplied by return. And then it will tell you, how much of, outstanding or what is the shortfall of that particular individual. So, and then you will say income from assets, and then income from RA annuity, all these other assets, income from RA annuity, less income tax, net income. So if they already have a retirement annuity, you will edit there and say, okay, this is the potential retirement annuity that we'll have based on the 2/3 that will get remaining after the lump sum is taken away. And then they will say the net income, maybe less income tax, net income. You look at net income minus the needs that the person has. And then you will be able to determine whether the shortfall or they have an excess. If there's a shortfall, then they have to make it up, obviously. by buying either additional retirement annuity or buying other, financial products that will supplement whatever that is already there. Some of the things that we need to consider will be, the interest rate, inflation rate. We need to make sure that the income is consistent, with the inflation rate, so that it's not the value of the money is not eroded. The annuity rates, the term, and the life expectancy, and the tax rates at that particular time. So all these data will have to be inputted into the system to make sure that we are able to determine the right kind of solution for the particular client, or how much they would need if they do have a shortfall.